Hi everyone, welcome back to my channel. Do you sometimes wondering why some of the business owners and entrepreneurs are more successful than the rest of them? The key is knowing your financial basics. In my previous video, we have looked at the importance of knowing your financial basics, and we also had looked at what's on the profit loss statement and how to use those informations to make better business decisions or solve real-time business problems. In this episode, we will have a look at the balance sheet. What is a balance sheet? You might wonder. Let's have a look at this balance sheet example together. Assets are things of value that a company owns, such as cash, inventory, equipment, and real estate. Here are two categories of assets: current assets and non-current assets. Current assets are things like cash in the bank, accounts receivable, and anything that can be converted into cash within a year. Conversely, things that a company will hold on for years fit into non-current assets, like fixed assets. Fixed assets are motor vehicles, plants and equipment, land and building, etc. What is the other type of non-current assets that are long-term investments? For example, a company owns shares in another company, or intangible assets such as trademarks, copyrights, or goodwill. Liabilities are debts or obligations that a company owes, such as loans, credit card balances, and accounts payable, money owed to suppliers. Like assets, it includes current liabilities and non-current liabilities. Accounts payable, in other words, bills to pay. Short-term loans are current liability. Anything that you have to pay off in a time frame over a year is non-current liabilities, e.g., a bank loan over 5 years, some hire purchase items, or financing lease, etc. Then, subtract your liability from your assets. That is the level of equity your business has. Equity represents the portion of the company that is owned by the shareholders. It usually represents the shares subscribed by shareholders or paid in capital, money invested in the company by shareholders, as well as the accumulated profit, which we call retained earnings over the years from the start of your company. The last one is usually your current year profit. Okay, you might say, why do I need to know my balance sheet? Isn't knowing my profit is enough to actually know how my business is doing? When you're in the negative equity position, which means your total assets is less than your total liabilities, regardless of your profit level, your business is in a more riskier and vulnerable position, which in turn reduces the chance for your business to weather any unforeseeable storm. So yes, it is absolutely essential to know your business position at any given time. Now let's have a look at how to use this business knowledge to operate your business more effectively and efficiently, increasing the profitability. Rule of thumb: do not use the single element of the things we just talked about. Always interpret all the numbers together to paint a more accurate picture of your business. For example, you might have a month with brilliant sales and revenue levels. However, when you look at your net profit, it's doing worse than a month that sales were not so great. You might think to yourself, what the heck's going on? Does this make sense? Word of advice: take a look at your gross profit margin. Are they lower than the average month? Simultaneously, have a look at your overhead expenses. Was there a higher level of expenses due to some random events? That shall tell you where things went wrong, so you can avoid that happening in the future. Another perfect example is, under the current economy, everything is cost much more than before, and everyone is increasing their price. Should I be increasing my price? How much can I increase it without losing any sales or revenues to my competitors? The short answer to this is, first of all, take a look at your competitor's price. So your price increase is not going to be astronomical compared to the market price. Secondly, work out your average overhead expenses and average gross profit margin in recent months. Let's look at an example here. If your overhead is $1,000 per month and your gross profit margin is 50%, and you use $1,000 divided by 50%, which is 0.5, that gives you $2,000. So you know the bottom line is $2,000 in monthly sales to break it even. And you're currently charging $3,000 per month, which should give you a $500 net profit before tax. You know your competitor is charging around $3,500. You still want to offer a competitive price to your customer. If you're charging around $3,000 to $3,200, you will earn around $500 to $600 profit per month. However, just to say the cost of goods sold increased due to the increasing cost of logistics, your gross profit margin is dropped to 30%, which means you will need to earn 3.3K new break-even point. How you calculate that is use $1,000 divided by 30%. That equals to 3.3K. If you're still charging 3K, which will leave you $100 loss before tax. 3K times 30% equals 900 minus overhead expenses 1K. That equals to $100 loss. So you need to charge both 3.3K to make any profit at all. So the game here is to find the sweet spot between the competitive pricing and acceptable profit level. Remember, knowing your financial basics will help your business tremendously, because you will have the full visibility into what's really going on with your business and with the market. Alright, I hope you enjoyed this video. If you like this video, please click like and share. Also, please comment on what other type of financial information you would like to know. Please subscribe and turn on the notification. I will see you in the next video. Bye.